a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about covered call ETFs or option income ETFs, which have gathered billions this year. This is one of the most important stories of 2023, how popular these ETFs are with investors. And according to Bloomberg, more than 20 billion has flowed into these covered call ETFs, mostly from retail traders. Now, these ETFs, if you want to invest in them, you should understand when they work best. So they will work best in sideways markets when stocks don't move up or down a lot. They will underperform the indexes, major indexes in strong bull markets. And when stocks fall, then these will provide some protection. So last year, 2022, was a terrible year for stocks. We know that. And that is why these ETFs, they outperformed the broader indexes in 2022. And that is why they gathered massive inflows last year. And in fact, we did talk about these ETFs last year when these were outperforming. So I thought this would be a good time to revisit them more than a year later. Now, this year has been great for stocks, particularly high-tech technology stocks. So these strategies, covered call strategies, have been underperforming the major indexes this year, but they continue to gather assets. And the JP Morgan covered call ETF, the ticker symbol is JEPI, that has become the most popular, the largest actively managed ETF now. And it has seen many copycats now follow that strategy, including major fund houses like BlackRock, Goldman. They have been launching ETFs, covered call ETFs that follow the same strategy. Now, let's understand how these ETFs, how these strategies work. So these basically use call options, as the name would suggest. They will hold a basket of stocks and sell covered call options on those stocks. So if stocks rise above a specified strike price, then the buyer of the call option will exercise his strike, and the ETF will have to pay the buyer of the option the difference between the stock price and the strike price. So that will cap investors' gain when stocks rise. On the other hand, when stocks fall, and if they go down below that strike price, the exercise price, the option expires worthless, and investors basically benefit from that premium income because option is never excised, and that option premium is pocketed by the ETF manager. So basically, these strategy, they have high income. Most of these ETFs pay out monthly income, so you get high monthly income yields, reduced volatility as well. But we know that there is no free lunch, particularly in the investing world. So your upside will be capped when in strong bull markets. Now, why I decided to do this video today is because I saw an interesting article on Bloomberg. So Bloomberg quoted a research study by quant veteran Ronnie Israelov, who is Chief Investment Officer at financial services firm NDVR. He called this a devil's bargain. He said that generating income using options basically undermines investment returns. And he examined a particular call selling strategy, replicated that strategy, and found that this strategy has lost money since 1999 and performance worsened over the past decade. So this is the Bloomberg article that I'm referring to. So if you want, you can take a look at this article and decide whether these strategies are meant for long-term investing and if they are meant for investing if you believe the stock market will go up. As I mentioned earlier, the strategies will outperform in sideways market. So if you're expecting stocks to go nowhere, basically, then maybe take a look at these strategies for extra income. Now let's take a look at 4 very popular covered call ETFs. The first one, JEPI, which I mentioned earlier, this has 30 billion in assets now, of which about 13 billion has come in 2023. This is an actively managed ETF, charges 35 basis points, and this basically holds a portfolio of low volatility 125 stocks with low volatility, and then it sells S&P 500 index call options. Now, if you want to learn more about this ETF, you can go to the ETFs code page on Zacks.com. We, in fact, published a guide to all these covered call ETFs because these are so popular with investors. So you can read our research reports, articles, and this guide too. Look at the dividend yield. And using the link, you can go to JP Morgan webpage for this particular ETF. So provides an attractive 12-month rolling dividend yields of 11.4%, SEC yield of 7.7%. So this, as I mentioned, is actively managed, and it uses JP Morgan's bottoms-up fundamental research to select those stocks, and it selects about 133 stocks currently. Now, the second ETF that I am talking about is also by JP Morgan. So, encouraged by the success of JP Morgan launched this ETF, which tracks the Nasdaq 100 index last year. And this has also quickly become quite popular, launched just last year, and has 6.5 billion in assets now, of which 5 billion has come this year. So the main difference between the two is this holds the Nasdaq 100 stocks. And again, let's go to the code page on Zacks.com and using the link, the JP Morgan webpage for this particular ETF. So this holds the Nasdaq 100 stocks, and then it will sell covered calls on the Nasdaq 100 index and very juicy dividend yields. For this particular ETF too, the 30-day SEC yield is close to 12%. And the third ETF that I'm highlighting is by GlobalX. So GlobalX ETF QYLD, this tracks stocks in the Nasdaq 100 index and then sells call options to generate that extra income. This has 7.7 billion in assets, of which 910 million came in 2023. This is slightly pricey, 60 basis points, and this holds all stocks in the Nasdaq 100 index. So again, let's go to the code page on Zacks.com. And from there, the GlobalX webpage, the yields is more than 12%. And as I mentioned, this will hold all the stocks in the Nasdaq 100 index. It is not actively managed, unlike the JP Morgan product. And the last ETF I'm highlighting is by GlobalX, XYLD. So this provides exposure to stocks in the S&P 500 index and then uses S&P 500 call options to generate that extra income. This has 2.9 billion in assets, of which 55 million has come this year itself. Again, let's take a look at this ETF by going to the quote page on on Zacks.com and using the link to go to this Global X web page. So as I mentioned, this holds all the stocks in the S&P 500 index and then writes call options on them. Both JP Morgan and Global X have some good research about how these covered call strategies work and whether they are suitable for you. So you should read those research materials. Again, the yields are very attractive. The 12-month trailing yield is close to 12%. So main difference between these two sets of ETFs is whether you should use actively managed ETFs and hold some stocks selected by the manager, or you should own all the stocks in the S&P 500 on the Nasdaq 100 index and use passive strategies. The answer is not very clear. So I looked at the performance this year for all these four ETFs. So both these sets of ETFs, they have underperformed the indexes that they track because stocks have done so well this year. So the QQQ index, the Nasdaq 100 index is up almost 40% this year. And the JP Morgan ETF, which tracks the Nasdaq 100 index and writes covered call options, JEPQ, that is up about 30% this year. The Global X product, QYLD, is up about 18% this year. Now, the S&P 500 index is up close to 16% year to date. The Global X product is up about 8%. And JEPI, the most popular ETF in this space and the most popular actively managed ETF, that is up about 6%. So in one case, the active managed ETFs did better than those index tracking ETFs, and in the other case, they did not. So the answer is not clear. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to all our videos, our video channels, so that you do not miss anything. And I'll see you next week.